Welcome students, I am Dr.P. Vijaya. Here we are going to start unit number 19, types of insurance. It is from block 5, insurance. Types of insurance. Insurance is broadly classified into two categories. One is life insurance and another one is general insurance. Life insurance. Life insurance is a contract between a life insurance policy holder and an insurer or an assurer, where the insurer promises to pay a designated beneficiary a sum of money upon the death of an insured person. Depending on the contract, other events such as terminal illness or critical illness can also trigger payment. The policyholder typically pays a premium either regularly or as one lump sum amount. The benefits may include other expenses such as funeral expenses. Life policies are legal contracts, and the terms of each contract describe the limitations of the insured events. Often, specific exclusions written off in the contract limit the liability of the insurer. Common examples include claims relating to suicide, fraud, war, riot, and civil commutation. Difficulties may arise when an event is not clearly defined. For example, the insured knowingly incurred a risk by consenting to an experimental medical procedure or by taking medication resulting in injury or death. Life insurance can be defined as a contract between an insurance policy holder and an insurance company, where the insurer promises to pay a sum of money in exchange for a premium upon the death of the insured person or after a set period. Life insurance contract may be defined as a contract whereby the insurer, in consideration of a premium, undertakes to pay a certain sum of money either on the death of the insured or on the expiry of a fixed period, whichever is earlier. The definition of life insurance contract is explained in Insurance Act 1938 by including annuity charges. Life insurance is a contract between an insurer and a policy owner. A life insurance policy guarantees the insurer pays a sum of money to named beneficiaries when the insured dies in exchange for the premium paid by the policyholder during the lifetime. The life insurance application must accurately disclose the insured's past and current health conditions and high risk activities to enforce the contract. Next, we will see the features of life insurance. It is long term that may go for 10 to 30 years or even more. You have to pay the life insurance premium for the term that you desire. This is called premium payment term. The one who buys a policy and pays a premium is the insured, or he or she can appoint a nominee or a beneficiary to receive the amount in his or her absence. Premium can be paid through regular monthly payments, annual payments, or a one-time payment. A life insurance policy can be a good saving investment plan for the future or a pension post-retirement plan. This depends on the type of policy. It can also provide tax benefits. It comes to aid in case of the ultimately of sudden death of the breadwinner of the family. If she or he is insured, then the family has a source of income. It makes them financially stable, independent, and perhaps liability free. Now we will see the kinds of policies. On the basis of the duration of policies, the life insurance policies according to the duration may be whole life policy and term insurance policy. Whole life policy. In whole life policy, the sum assured is payable to the legal heir only on the death of the assured. It is to protect and support the family of the assured after his death. Under the scheme, premium may be payable throughout the life of the assured or for a limited number of years. Next is term policy. This policy covers the risk only during a particular period. The sum assured is payable only if the death happens during the term. Under this policy, premium rate is lower than any other policy. Nowadays, in order to attract more people, policies is issued with the condition that the premium paid will be returned after term is over, if death does not occur. Next, on the basis of the payment of premium. The policies according to the payment of premium may be of the following types, that is, single premium policy and limited payment whole life policy. On the basis of the participation of profits, policies according to the participation in profits may be without profit policies or without profit policies. Next, on the basis of the number of persons insured. On the basis of the number of persons insured in a policy, the policy may be single life policy and multiple life policy, joint life policy, last survivorship policy. And on the basis of method of payment of claims, it is classified into two, that is lump sum policies, installment or annuity policies. And there are some few life insurance policies which are as follows. Money back policy. The money back policy, also commonly known as the child money back plan, is a life insurance product offering life cover during the plan's tenure and maturity, survival benefits after end of the policy term. It is both an investment and life insurance plan typically purchased for children. Children's Deferred Assurance, that is CDA. It is a child insurance policy such that the premium is paid till the child reaches 21 years of age and then child becomes the owner of the policy. If the child dies within the policy tenure after risk commencement, then the sum assured along with guaranteed additions are paid and the policy is terminated. The deferred endowment plan for children comprises of two stages, the deferred period and the insurance period. The deferred period covers the time from when the policy begins to the time when the child turns 18. The period from the time the child becomes the owner of the policy at the age of 18 to the maturity date of the policy is the two stage. The risk of this policy begins when the child turns 18 and from then on his life is also insured. The deferred date under plan number 50 is a policy anniversary date that comes on or after the child's 18th birthday. Next, group insurance policy. Group insurance policy is a plan of insurance which provides coverage to a number of persons under one contract. Group insurance is available to the following groups: employer and employee groups. Here, employer takes out a master policy for the benefit of his employees. The master policy is in the name of the employer or a trust formed to administer the scheme. Labor union group. A master policy is taken out by any trade union for the benefit of its members. The cost is met from the union's fund. Creditor and debtor group. The master policy is taken by the creditor or to cover the outstanding amount of loans granted to debtors. In case of death of a debtor, the claim amount can be applied towards the repayment of loans outstanding in his name. Next, we will see the important term called surrender value. So, while taking insurance, this term we will hear in many terms, in many ways, that is surrender value. The surrender value is the cash value of the policy which is payable to policy holder and if he decides to terminate the contract. This surrender value is usually obtained from the paid up value by applying a percentage factor. This percentage factor will vary according to the plan of assurance, the original term of the policy and the duration elapsed since the commencement of the policy. The surrender value is the amount of premiums paid which is returned the policy holder at the time of surrendering the policy. Next, we will see the term about nomination. Nomination is a process by which the policy holder appoints a person or persons to receive policy benefits in case of a death claim. Nomination is a process of determining one person or persons who will receive the benefits from the insurance policies in case of any casualties. The nominee in life insurance can be anyone as per policyholder's choice. In general, the nominee of insurance is a close relative. According to Section 13 of the Insurance Act 1938, nomination is a process of appointing or nominating a person or persons by the insured to receive the payment of the policy in the event of death. The person who is authorized to receive the payment of the policy is called the nominee. If the policy matures by expiry of time, the policy amount is payable to the insured himself and not to the nominee. The nomination can be done only by the insured person. If a policy is insured on the life of another person on a proposal made by a third person, such a proposer is not entitled to make a nomination. Next, we see the second type of insurance, that is called general insurance. Insurance contracts that do not come under the ambit of life insurance are called general insurance. The different forms of general insurance are fire, marine, motor, accident and other miscellaneous non-life insurance. Points to remember the general insurance is as follows. A policy or agreement between the policy holder and the insurer which is considered only after realization of the premium. The premium is paid by the insurer who has a financial interest in the asset covered. The insurer will protect the insured from the financial liability in case of loss. General insurance includes types of insurance except life insurance. And these are the general types of insurance. General insurance. First we see fire insurance. Fire insurance is a kind of contract between the insurance company and the insured where the insurer assures. The policy helps the insured to cover the risk of loss of property by accidental fire cases in exchange for a manual premium. Types of fire insurance. Valued policy. This is a fire insurance policy in which an agreement is framed and the insurer undertakes to pay in the event of destruction of property by fire. Specific policy. This is a fire insurance policy which insures a risk for a specific amount. In case of any loss under this policy, the insurer pays all the loss provided. It is not more than the sum specified in the policy. Thus, the value of property is not considered for this purpose. Average policy. This is a fire insurance policy that is insured if the property is underinsured. That is, the insured for a sum smaller than the value of the property. The insurer must bear only the proportion of the actual loss which the sum assured bears to the actual value of the property at the time of loss. Floating policy. This type of fire insurance policy covers several types of goods lying at various locations for one amount and one premium. The premium normally charged under this policy is the average of the premium that would have been paid if each batch of the goods had been insured under the specific policy for specific sums. Excess policy. When the stock of the insured fluctuates, the insured can take a policy for an amount below the amount in which his stocks do not normally fall under in this instance. The insured might have to take another insurance policy to cover the maximum amount of stocks, which might reach sometimes. The former type of policy is called first loss policy and the later is called excess policy. Blanket policy. A blanket policy is that which covers all assets fixed as well as current under one policy. Comprehensive policy. An insurance policy which covers risks such as fire, flood, riots, strikes, burglary, etc. up to a certain specified amount is known as a comprehensive policy. And consequential loss policy. The objective of this insurance is to indemnify the insured against the loss or profit caused by any interruption of business due to fire. It is also known as a loss of profit policy. Reinstatement policy. It is a policy under which the insurer pays the amount which is sufficient to reinstate assets or property destroyed. Next, we see marine insurance. Marine insurance is the most important and challenging branch of insurance. It has developed over many countries. Under this, the insurer undertakes to indemnify the insured against marine loss. The principles of utmost good faith, indemnity, insurable interest and proximate cause will apply to marine insurance. Both insurable interest is present at the time of loss of the insured property. Marine Insurance Act 1963. The Marine Insurance Act in India came into existence in 1963. As per section 3 of the Act, any time the term marine insurance is used, expressed or even extended for the insuring of goods against loss or damage, the insurer will be at risk to bear the charges. The insurer will consider all the certainty of goods in case of misfortune sustained during marine ventures. Kinds of marine policies. Marine policies are of different types. They are divided on different bases. Some of them are discussed briefly. On the basis of the subject matter, policies are classified into cargo insurance, hull insurance, freight insurance, and liability insurance. First, we will see cargo insurance. The cargo may be of any description. Example, wares, merchandise property, machinery, goods, etc. This branch deals with insurance of goods while in transit by ship. It provides protection against various risks such as fire, explosion, collision, theft, cyclonic storm, etc. Hull insurance. Hull insurance mainly deals with the insurance of ocean going vessels, fishing vessels, yachts, dredgers and builders risk when a ship is under construction. This policy covers risk of fire, collision, storm, stranding, and liabilities against third parties. Freight insurance. Freight is payable for the carriage of cargoes, or if the vessel is chartered, hiring charges is payable. The carrier will lose the freight if the cargoes are not delivered at the designation. In that case, the insurance company covers the risk of freight loss. Liability insurance. This may include liability arising out of hazards such as collection, running aground, damages to harbour, etc. Insurance can also be taken for the expenses involved in non-compliance of rules and regulations. Next, on the basis of duration, policies may be classified as follows. Time policy. Time policy are specific as to the period. In this policy, the period or time covered by the insurance is to be specified. As per sections 27(2) of Marine Insurance Act 1963, at a time policy which is made for a time exceeding 12 months is invalid. Hence, a time policy is only for a period of 12 months. Voyage policy. Under this contract, insurance is made for the duration of a particular voyage. This will cover the distance between the port of designation and the port of departure. Next, on the basis of terms, construction or builders risk policies. These policies are against the risks so incidental to the construction of the vessel from the time of laying the keel of the vessel till the same is delivered after test voyage. This type of policy may also be affected when a vessel is undergoing repairs and is in dry docks. Port risk policies. The policy covers all types of risk to the ship and its cargo while the ship is at a port. It covers any loss at the harbour from the time the ship arrives at a port till it commences its own voyage. Floating policies. Under this policy, the insured need not declare anything specifically about shipments. It provides a continuous insurance protection automatically during the period for which the policy is issued. Open cover policies. This is an arrangement for granting unbroken and automatic protection to the dispatchers involved in a stated period of time. The mutual obligation being for the insured to declare all shipments and for the insurer to grant cover for all such shipments. The open policy covers the shipments during specified time on a worldwide basis, that is, anywhere to anywhere, any basis. Next, we will see burglary insurance. A burglary insurance policy offers an additional layer of security to your property. It offers coverage for damages for misfortunes caused to your property and its contents. For example, your home, office, factory and godown against burglary and house breaking. Types of burglary insurance. Burglary business premises insurance policy. Business premises are generally covered from the risk of burglary and house breaking only. Mere theft without the use of force and violence is not covered. Policies issued to business premises cover stock in trade, goods held in trust, fixtures and fittings, etc. against the risk of burglary and house breaking. Burglary private dwellings insurance policy. These policies cover theft risk also in addition to burglary and house breaking risk. The total contents are to be insured for their full value. Under this, one policy may be issued for a furniture and household goods and personal effects and another for jewellery and valuables. Next, jewellery and valuable insurance policy. These policies cover the loss of jewellery and valuables, but cover is not cooperative while the jewelry adorns on the body of a person and loss arising while jewelry being worked upon. All risk insurance policy. All risk insurance policy seeks to cover loss or damages by fire or burglary or theft or by any other accidental fortuitous circumstances. This policy is specially suitable for jewelry, valuable works of art, paintings and other similar articles. Next, we will see the medical insurance. Medical insurance are a mediclaim policy. Under the scheme of mediclaim, the insurance companies may pay for the insured hospitalization, domiciliary hospitalization, intensive care, surgery and other related medical expenses. With a small annual premium, the insured can avail of all the medical benefits up to limits specified in the policy. The premium rate depends on the category and the scheme has to be selected by the insured. Types of medical claim policy. Under medical claim policy, insurer offers two schemes of the insured. They are Mediclaim with personal accident insurance, Mediclaim without personal accident insurance. The maximum benefit under scheme A is 1,50,000 and the scheme B is 96,000. The policy is issued to all Indian citizens. Income tax benefit is available on the amount of premium paid annually. Mediclaim policy is a boon to middle and low income group families. Nowadays, medical and surgical expenses are increasing. One finds it difficult to meet the mounting hospital expenses. This scheme is becoming popular in India in recent times. And this is the other general types of general insurance. Pension plan insurance. Pension insurance contract is an insurance contract that specifies pension plan contributions to an insurance undertaking in exchange for which the pension plan benefits will be paid when the members reach a specified retirement age or on earlier exit of members from the plan. Annuity insurance. An annuity is a plan that helps you to get a regular payment for life after making a lump sum investment. The life insurance company invests the money of the investors and pay back the returns generated from it. Rural insurance. Rural insurance is basically insurance that has been credited for or created for the rural public to insure their businesses such as poultry, cattle, farming, etc. Individuals can claim benefits in case of death of animals or loss of crop, etc. The government launched many schemes for the benefit of the rural sectors. Thank you.